I want to discuss how to invest with sector rotation strategies. Sector rotation strategies, it's a strategy for every market cycle. Sector rotation in investing is a strategy that involves shifting investment between different sectors of the economy, based on the expected performance of those sectors, during various phases of the economic cycle. The idea is to allocate capital to sectors that are likely to outperform, during a specific stage of the economic cycle, you know, either in the growth phase or in the contraction phase. You buy stocks that will then outperform, other sectors during these phases of economic movement. The key concept here is involved. Number one here is economic cycles under key concepts of sector rotation. The economy typically moves through various phases, including expansion, peak cycle, peak period, concentration, contraction, and trough. The trough there is the bottom. So different sectors tend to perform better or worse depending on the phase of the economy, the economy is in. So we want to talk about the expansion phase now. During this phase, the economy is growing, and sectors like technology, consumer, discretionary, and industrials, they often perform during a typical economic expansion. These sectors do better. When it comes to the peak, as the economy reaches its peak, sectors like energy and materials, which benefit from high demands, tend to do quite well. And then when it comes to contraction, in a slowing or contracting economy, defensive sectors such as consumer staples, utilities, and healthcare generally outperform because their products and services remain in demand even during tough times. The nature of what they provide, their products and services, are always in demand, no matter how tough the economy is. Even in a contraction, people still demand the nature of the product or services they render. Then during a trough, as the economy begins to recover, cyclical sectors like financials and industrials may start to outperform as they benefit from the early stage of economic recovery. So at the very trough, companies in the financial sectors, will tend to do better in the financials because in no distant time, the economy will pick up and start to expand again. It's a circle: expansion, peak, contraction, trough, expansion, peak, contraction, trough, just like that. And you have to adopt sector rotations to be able to capitalize on each of these phases of the economy. And so, number two here is sector ETFs and funds. We've discussed economic cycle. We want to talk about sector ETFs and funds. So investors often use sector-specific, exchange-traded funds or mutual funds to easily gain exposure to different sectors. Some funds are dedicated to investing in a given sector. So when you buy those funds, you're invariably investing in those sectors. And this allows for quick reallocation of investment as economic conditions changes. So very easily you can buy a sector-based ETF or a sector-based mutual fund, and you could sell out very easily, and it guarantees that ease of reallocation of your fund to another sector depending on the phase of the economic cycle. Number three is indicators and analysis. Indicators and analysis. Investors may use various economic indicators such as GDP growth rates, that's gross domestic products, interest rates, and employment data to anticipate which sectors are likely to perform well. So you could use this data to be able to analyze and understand which particular sector would likely perform well. They may also rely on technical analysis to time their entry and exit from specific sectors. So in this case, you inculcate technical analysis to know when to go in and when to exit, a given sector. Number four is diversification. Sector rotations can also be a tool for diversification, allowing investors to spread their risk across multiple sectors rather than being overly concentrated in one area. So with this sector diversification, you can place your bets across different sectors. By so doing, you diversify your investments and reduce risk. So you equally have strategy approaches. What are the strategy you could utilize when it comes to sector rotation strategy? Number one is top-down approach. Top-down approach. This involves analyzing the broader economic environment first, then identifying which sectors are likely to benefit from current or expected economic conditions. You start from the top, and then you make a decision from the top by considering the broader economy or the macro economics. Number two is relative strengths. So investors may also compare the performance of different sectors against the broader market to identify which sectors are gaining momentum and which one are losing momentum. So you have to employ relative strength index to identify sectors that are doing well and sectors that are not doing well. Number three is tactical versus strategic rotation. Tactical versus strategic location. In this context, you have tactical rotation. This involves frequent adjustment to sector allocations based on short-term economic forecast or market movements. In this case, you are more concerned about short-term, forecast as it relates to economic movements and performance, and that will guide your investments. You equally have strategic rotation. When it comes to strategic rotation, it involves longer-term adjustments, aligning sector investments with the anticipated economic cycles over months or years. In this particular context, it's a long-term activity, it's a long-term process. But in tactical rotation, is a short-term commitment. So we equally have risk and reward, kind of, pros and cons, the pitfalls and the benefits of sector rotation strategy. So when it comes to the reward, and when executed successfully, sector rotation can lead to higher returns by consistently allocating capital to the best performing sectors. It also offers a way to manage risk by avoiding sectors likely to underperform. That's a very good advantage of sector rotation. You identify sectors that will do very well based on the peculiar economic, peculiar phase in the economic cycle, and then you carry out your investments. Then the risk here will involve the strategy requires accurate prediction about the economic cycle. That's the risk there. Can you accurately predict, what the economy will do in the next months? There should be that accurate ability to accurately make predictions, which can be challenging. So mistimed rotation can lead to missed opportunity or losses. If you mistime your rotation, you enter a particular sector at the wrong time, it will generate losses in your portfolio. Additionally, frequent trading can incur, higher transaction costs. If you are doing your rotation on a short-term basis, in and out of different sectors, then that will incur trading costs, and sometimes even capital gain tax uh, will equally affect you. So who are those that are that will them that could use these strategies, this particular strategy? Sector rotation investing is suited for investors who have a good understanding of economic cycles and are comfortable with making regular adjustment to their portfolios. Maybe you become more of an economist than an investor. You just have to have a broader understanding of economic cycles. It is more active. It's a more active form of investing and requires staying informed about macroeconomic trends and market conditions. You have to be informed about macroeconomic trends and the phases of the economy at every given point in time. So without adequate knowledge of this information, you will not be able to do well as somebody adopting sector rotation strategy.